So, good evening once again, everyone. I want to thank you for being here. I do appreciate it a ton. And tonight we're going to talk about Heikin-Ashi trading. You know, I did a video some time ago about Heikin-Ashi candles, and it's turned out to be one of the biggest videos that I've ever done on YouTube anyway. It's really being watched heavily, and I thought, you know, one of these days I need to get around to doing a full-on strategy video, not just talking about the Heikin-Ashi candle, but the full-on strategy to trade these candles. And so that's what we're going to do tonight. Anybody trade Heikin-Ashi in here at all? Ellie, Peter, Bianca occasionally, Rick, Paper, Gwen. All right. Well, this might be of interest to you and don't even know the term. That's okay. Okay, let's talk about Heikin-Ashi. First, let's take a second and let's talk about what is a Heikin-Ashi video. If you translate Heikin-Ashi from Japanese, what it means is average. Heikin is average, Ashi is pace. So average pace, okay? Heikin-Ashi is average pace. Now what does that mean? What that means is they take a standard candlestick. You know, if we were to look at a regular daily chart of, let me remove these lines, but a regular daily chart of AT&T, it looks like this. A lot more back and forth, a lot more black candles in there, kind of disarray, right? The Heikin-Ashi chart smooths all that out. Okay, it cleans up that jumpiness. Notice that there are no gaps, while over on this chart we have gaps. On this chart we have no gaps. And the reason is because they take two time periods and average them together to create the Heikin-Ashi candle. So let me explain that for just a second. If you use a daily chart, they're going to take 2 day periods, 2 1-day periods, and basically average them together to give you that candle. Okay? So one of the major benefits of Heikin-Ashi is the smoothing effect of the Heikin-Ashi, the way that smooths the trend and cleans things up. Is there anybody in here that has or would admit to the fact that they have a little problem in their trading with micromanagement? Meaning that they're watching it all the time and that candle wiggles back and forth and you get real nervous and anxiety builds up and you micromanage your trade. End up stopping yourself out or doing something that causes you some problems in your trading. Now, I refuse to admit that. I want to show you that you can use the Heikin-Ashi on any time frame. So I'm going to use the same AT&T chart, and let's look at a 4-hour chart. The 4-hour chart has trends. It has support, resistance, everything that we see in every other chart, but it's cleaner. It's more organized because of the average of these candles. Now, keep in mind that the Heikin-Ashi candle on a 4-hour chart is averaging 2 4-hour time periods. If you use an hourly chart, it's going to be the same thing, and it's going to average 2 1-hour time periods to get that smoothing effect in the chart. Now let me explain the candles themselves. I'm going to go back to a daily here. When you take a look at a Heikin-Ashi candle, notice that we have these. It's kind of odd if you look at candlestick charts all the time, that these candles right here, notice they have no tails. Not one tail. When a Heikin-Ashi candle has no tails, it indicates strong uptrend. Okay? No tails indicating strong uptrend. When a Heikin-Ashi candle has no wicks, it's indicating strong downtrend. Okay, so you can use that information to stay with the trade. If you struggle with micromanagement, the Heikin-Ashi candle can help smooth out that price action, help you avoid some of that emotion in the trade. Okay, so when you see periods in the chart where we have wicks and tails coming together, that's a period of transition. Okay, we don't know for sure if it's going to continue to move up or move down, but because we're following this trend, we would be watching for that next potential move up in the trend. Okay, we're going to be trend followers on the Heikin-Ashi just like anything else, and we're going to follow that very stable, clean chart as it moves up in these trends or moves down in a trend, because it is very, very stable and pretty darn easy to follow. Okay, so how do we put together a trade for Heikin-Ashi? I'm going to show you something. You guys have all seen me do the 3/8 trap. The 3/8 trap is what I use on a standard chart, and I've changed it up here. It's very, very similar. It's almost identical, but because of the math involved in Heikin-Ashi, okay, nope, I've not modified the Heikin-Ashi settings at all. Heikin-Ashi candles are just simply setting up the Heikin-Ashi. I've made them one color. Okay, using black, so I have a white background chart, black and white candles. It's very, very clear, very visual, very easy to see. No modifications to the candles at all. Okay, very, very simple. So what I've done to put together a pattern to help you identify these trades is I've added in on these charts a 2 exponential moving average and a 6 exponential moving average. If you guys have followed the 3/8 trap, this will be very, very familiar to you, but because of the math, we have to do a little bit of, you have to use a little bit different moving averages to get the same effect. Okay, so with the 2 exponential moving average and the 6 exponential moving average, we create a trap. And what is the trap? Well, I'll explain this way first. If this is that 8 exponential moving average, then what I want to see is I want to see that 2 exponential, excuse me, it's a 6 and a 2, I keep saying 8, that 6 gets crossed up by the 2. It's not the cross that we're looking for. This is not the trade. What we're looking for is that pullback that holds above the 8 and then shows us that entry signal. Okay, that pullback. So this right here is almost the perfect entry signal into this Heikin-Ashi strategy. We have that nice gradual pullback. It holds above the 8. Buyer step in here, and you guys can see you have a nice up move in that trade. And it follows the same right in here where we cross down and cross right back up. This would be the entry right here into that trade. We break through that resistance and we have that nice follow through to the upside. Okay, it's the 2 and the 6. The 2 and the 6 exponential moving averages that make up that pattern. So step number 1 is we want to find stocks that are trending. How can we find stocks that are trending? Well, one of the things I do is I like to use a trending 17 EMA moving average. Okay, that helps me find the trend. Now, if you guys don't know how to write a scan for this, it's actually fairly easy. I'm working with Ed right now, and we're putting together a Heikin-Ashi scan based on this strategy that all you'll have to do is turn it on and it's going to find the charts setting up for this trade. Okay, it'll find them for you. So we're working on that right now. It's a little bit more difficult because of the math involved, but it's very, very similar to our regular 3/8 strategy. Now, one of the things that is a disadvantage or a hang up or a problem with Heikin-Ashi is you don't get, because it's an average, you don't get the actual current price of the stock. So for example, it's showing on Heikin-Ashi that our price is 37.60. If we go over here to this chart, you can see it's 37.38. That's the actual price of the stock. So that's one of the downfalls to the Heikin-Ashi. If you decide to follow this strategy, either you have to get comfortable with that fact that the current prices that it's showing here, because the average, are not the exact price, or you have to adopt a strategy where you buy your stock based on your normal candlestick chart. But then to avoid the micromanagement, manage it with that Heikin-Ashi after you've entered the trade. Stay with the trade because of the Heikin-Ashi. You can avoid that micromanagement because it's real easy in here as this moves up to just follow those candles. No tails, strong uptrend. Okay, and this works on any time frame. You know, for example, if you take a look at the diamonds chart and go to a 15-minute on that sell-off today, how sweet and easy was that right there? Cross down through that 17 EMA. Right in here would have been a great short trade, and just follow that position down on a 15-minute chart. It'll work just the same on any short-term chart if you go even shorter than that. It's very, very clean and very, very simple. Now remember, the short trade, like I said, the long trade, we take that 6 exponential, we want that 2 crossing up, pulling back, holding a support, and then we see buyers stepping in on the candlestick signal. The crossover is not the entry signal. It's the consolidation or the pullback that holds support that is the potential entry signal. This is our low risk entry where we can get our stop losses close, and that's critical. We want to have those low risk entry points. Okay, now the same is true in any down move. If we have the market moving down, we don't want the cross down. We want that rally back or consolidation that fails for our short trade. Okay, so you can look through this pattern here. Let me blow this up just a little tiny bit on this chart. Notice that 3, excuse me, I keep saying 3 because I'm used to talking about the 3/8 trap. The 2 crossing down below the 6 exponential moving average, and then turning back into this 17, turning back up, and then we get this failure. So the real simple entry into this trade would be just under this break right here and a stop loss just above. And then we trail that stop loss down following that trade. Doesn't matter the time frame, remember. We can follow this trade in multiple setups. Same thing setting up right in here. We can catch that failure in here, stop loss just above. Same thing through here, catch that failure in here, stop loss just above. So we're looking for those low risk entry points and just following the trend, not trying to predict the trend, just following the trend. Bob, the reason I'm using the 2 and the 6 is because of the math of the Heikin-Ashi candle. The 2 and the 6 best replicates the 3/8 trap on a Heikin-Ashi. Okay. It's just because of the mathematics of how the candles are calculated. Okay. What I would do on something like that, Stella, is if I were going to follow an hourly chart, I would just manage the hourly chart. Don't overcomplicate it with 2 different time frames because you get that contradictory information that could cause you problems. So no, when you see these strong downtrend candles, just follow them. Just move your stop loss, adjusting that trade down as you see fit as this stock moves down until boom, you're out of the trade. Or until you've hit profit targets in the position. Okay. So now let's take a look at the consolidations in these charts. And I'm going to go back to a daily. And I'm going to, let's just pick something like Visa here on a daily chart. I'm going to go back here when it was trending really nicely. During this period back in here, I want you to notice that we have the same pullback opportunities that we have in a standard candlestick chart. So we move up. Remember, this isn't the trade. We're not trying to catch this here. We're getting that cross back over. We're looking for that pullback that holds above the 8, excuse me, the 6, holds above the 6, and then we're looking for that entry in here. So right in here, see these 4 candles that are really small, really tight? One of the great things about Heikin-Ashi is that the consolidations are extremely concise. They're extremely concise. Okay, so we can hold this in here, set a price alert when we see those tight consolidations, and we wait for the entries into those trades. Find those areas in here where we would break out and just follow those entries into the trades. When we get those tight transition periods, those periods where we get those wicks and tails, that nice tight transition, we're looking for that breakout. So the pop out of the box and the PBO work here just exactly the same way as it does in a standard candlestick chart. The two patterns that we trade most of the time. Okay. Rick, I'm not sure what your question is. You are out in the change of color of the candle. Oh, are you saying you exit the trade at the change of the color of the candle? Well, certainly if you have not reached your profit target. Remember, I'm gonna go through how I plan a trade anyway. I'm going to go through how I plan a trade in a position like this. And remember, I am always planning a trade to a potential goal. Okay, always planning a trade to a potential goal. So let's think about this position. If we were going to enter, say we're watching this trade back here in Visa, and we see this price action that's showing us this nice little pullback. We're holding in here. We're looking pretty good. And we want to find an entry into this trade. So as this is forming and it's holding up, what I want to do is I want to place a price alert in here. And then I want to take a look at where, if I enter a trade here, I want to calculate how much my risk is. If I place a stop loss underneath these tails, by the way, that's important. It can't be at the tails. It must be underneath the tails. Okay, that's where the price support is showing up. And notice how concise it is in a Heikin-Ashi candle. Okay, we tighten up that price action in these candles because of the way they're calculated. So we tighten up that stop. Okay, we enter this trade. And you guys know that what I'm always going to do, I will not enter a position ever, whether it be a stock trade or an option trade. I will not enter a position until I know how much risk there is in dollars to my stop loss. I will not enter a trade until I know how much risk there is. Okay, so that's the first calculation you have to make. What's my risk? Where will I stop out? You need to know that before you enter. You also need to know what your tolerance to risk is. If you don't know how much you're willing to risk on a trade,